Hi, my name is Jeremy Zirin, and I cover real assets at Marquette Associates. In this series of Alternatives 101, I will be covering real estate. For the agenda, I will start with a general overview of real estate, followed by how to invest, and finally, real estate within a diversified portfolio. I'll begin by discussing the distinction between residential and commercial real estate. Residential real estate includes homeownership and primarily serves as a necessity and lifestyle choice and an investment second to those needs. Additionally, homes do not produce income for the owner. Rather, returns are driven entirely by price appreciation. Commercial real estate, on the other hand, is primarily a business function that generates regular cash flows from rental income of tenants and with appreciation representing a smaller portion of total return. There are many different property types across the real estate investment universe. These property types are typically divided between traditional and non-traditional. Traditional sectors include office, industrial, retail, and multifamily, whereas non-traditional include hotel, self-storage, senior living, medical office, and single-family homes, to name a few. Traditional property sectors represent the majority of the commercial real estate investment universe, whereas non-traditional represents a smaller percentage. Additionally, many of the non-traditional property sectors exhibit defensive characteristics and are driven by demographic trends that are secular in nature versus cyclical. There are many ways to invest in real estate, including private and public, and both equity and debt, each with its own unique characteristics. For example, investors can access public equity real estate through REITs, which are open to the public markets, including retail investors, whereas private equity real estate typically includes institutional investors and is not listed on an exchange. There are three main styles of real estate investments, including core, value-added, and opportunistic, ranging from least risky to most risky, respectively. Core real estate includes investments in high-quality, fully leased properties in prime locations with low use of leverage. The majority of the return is expected to come from income. Value-added investments typically include direct properties with significant leasing risk or development risk, utilizing higher leverage. And opportunistic investments include development projects with significant leasing risk and high leverage, where the majority of the return is expected to be driven by appreciation. Adding on to the previous page, where I highlighted the differences between the three main real estate investment styles, this table highlights some of the more granular differences between the three, including things like expected return, holding period, market focus, leverage, and fees. For example, core real estate returns are lower than value added and opportunistic, given the lower level of risk, higher occupancy, and primary market focus. Also, management fees on core real estate funds are much lower than value added or opportunistic and typically do not include a performance fee. Understanding cap rates is a must when it comes to real estate. Cap rates are the expected first-year income yield on a given property and is defined as the ratio of net operating income to current market value. Cap rates are commonly used to estimate the values of a particular property, and it is important to note that there is an inverse relationship between cap rates and the value of a property, assuming income is constant. For example, a lower cap rate would imply a higher property value, all else equal. Real estate doesn't come without varying levels of risks, which are important to understand. The real estate market is affected by many factors, including general economic conditions, the financial condition of tenants, buyers and sellers of properties, changes in supply and demand, availability of financing, and changes in interest rates. Other risks include liquidity, or lack thereof in some cases, leverage, particularly in value-added and opportunistic investments where leverage is typically higher, transparency, diversification, and valuation methodologies which can vary by investment manager. In terms of vehicles, there are many ways to access real estate investments, including open-ended funds, closed-ended, separately managed accounts, fund-to-funds, and even co-investments. Open-ended funds typically include core real estate strategies, but may include core plus and value-added. Open-ended funds are evergreen in nature and offer quarterly liquidity. Closed-ended funds, on the other hand, are primarily for value-added and opportunistic real estate investing. These vehicles are less liquid than open-ended funds, usually with an 8 to 12-year lock and higher fees. This next section looks at real estate within a diversified portfolio. From a risk, return, and correlation perspective, private real estate, represented by the NCREIF Property Index, exhibits attractive annualized total returns at low levels of risk measured by standard deviation of 9.1% and 4.1% respectively since the inception of the index through 2018. Additionally, private real estate exhibits low correlation to both equities and fixed income, represented by the S&P 500 and MSCI for equities, and BarCap Ag for fixed income. Private real estate, represented by the income returns of the NPI, or NCREIF Property Index, and the NFI Odyssey, exhibit attractive income. Historically, average annual yields for real estate have been slightly over 7%, which compares favorably to fixed income and U.S. equities. To conclude, benefits of adding real estate within a portfolio include high current income, superior risk-adjusted returns, access to a large investment universe, diversification, and a potential hedge against inflation. This concludes my discussion on real estate. Thank you for watching, and I hope you have a great day.